So far, this situation continues. There is not very clear signals if the soft patch will continue into the second half of the year, even though there are incipient positive news in some latitudes. The main reason has been related to the trade disputes and with the impact it has had on expectations, which has affected investment. Many banks have not yet managed to fully repair their balance sheets and adjust their business models. The emergence of big tech as a competitor, analyzed in Chapter 3 of the report, further adds to banks' challenges.
Public policy towards big techs in finance needs to build on a more comprehensive approach that draws on financial regulation, competition policy, and data privacy regulation.
In particular, Southeastern Asia and in the US. Corporates have been issuing a lot of debt in the capital markets, and it has not only been the better rated companies that have been issuing, but also a high risk or high yield type of debt has been issued. High levels of debt also point to vulnerabilities in a number of emerging market economies. The current vulnerabilities reflect in part spillovers from prolonged accommodative monetary policies and advanced economies, as emerging market economies are especially vulnerable to capital flow reversals and exchange rate fluctuations.
After the financial crisis of the 1990s, they adopted inflation targeting with more flexible exchange rate regimes, but they haven't moved all the way to freely floating exchange regimes, which is what the standard book would say. Moreover, they have complemented this with macroprudential measures.
Monetary policy cannot be the engine of higher sustainable capital growth. To see past the clouds to blue sky, a more balanced policy mix is badly needed. A sustainable flight path requires the long overdue full engagement of all four policy engines, rather than short-term turbocharges. By taking a longer view, one can better balance the need of today with the needs of tomorrow.